Hi traders, and welcome to my video on the EMA trend indicator. In this video, I'm going to show you a simple strategy that you can use to take advantages of moves such as this one for almost 600 pips, and also this one for around 500 pips. Okay, so this is a simple strategy. We're going to be using the EMA or Exponential Moving Average indicator. So first of all, we want to put the indicator onto our charts. So here I have moving average. Just use the default 14 period and change the moving average method from simple to exponential. Click OK. And there you can see the EMA is now on the chart, this red line here. Basically, with any moving average, we're just looking to place long trades or buy when the price is above the moving average, or place short trades or sell when price is below the moving average. Okay, and we can also use it to look at exiting positions, perhaps if the trend might be turning. Okay, you can change the periods as well. So you've got the default 14 period, which is the last 14 bars. If we just put it on 50, be the last 50, and you can see that it's less sensitive. Just zoom out there. Okay, it's less sensitive, and even more if you go to 200, even more less sensitive. Okay, but we'll stick to the default 14 for now. What you don't want to do with this indicator, what I wouldn't do, is buy and sell every time price crosses it. As you can see in situations like this, ranging and consolidating markets, you're just going to get whipsawed or chopped in and out of the markets for fun. So I wouldn't do that. What I'm going to do is I'm going to look for a trend. Okay, and then I'm going to use the moving average to help me decide if and when I'm going to buy into this trend. Okay, so the first thing to do is we mark our support resistance. So we have our support level there. Okay, the resistance level around here, arguably here, or we could look at shorter term resistance, such as this. Okay, you can see this resistance has been tested on multiple occasions. That's why we have this big breakout candle here, and then a pullback. You can see the resistance then becomes support and we start this upwards trend. Okay, so this is the consolidation or the range. This is what I don't want to trade in. I want to wait for a breakout, either long or short, either upwards or downwards. Okay, so you can see the market started to make higher lows here. Okay, so higher low, higher low, higher low, higher low. This means that the market is trending upwards. Okay. We also had a breakout of this resistance level. Can in fact mark it as far back as there. This resistance level here, you can see, had a significant breakout around this point here to the upside. Price is above the moving average, the EMA. Okay, we have a pullback which touches this resistance come support level, and then a continuation of the trade. So we could have entered here on this breakout. Okay, reason being is because price is above the EMA, market's making lower highs. You can see just by using your eyes and looking at the chart that the price is moving upwards. Okay, and then we can trade on the breakout. If we did that, I would have put my stop loss here below the low somewhere, so around 30 pips, which is not terrible for the 1 hour chart time frame. By the way, this is a 1 hour pound dollar or GU chart in the MT4 trading platform. You can use this strategy on any trading platform and any trading instrument, from Forex, crypto, stocks, commodities, bonds, indices, etc. And any time frame. I like to stick to the 1 hour, 4 hour, daily, weekly, and monthly charts simply because they contain more price data, and thus I find the signals tend to be more reliable. Don't understand why you would stress yourself out trying to capture a few pips on the 1 minute or 5 minute time frame and pay spreads, commissions, slippage, etc. when you can capture moves like this one. Let's have a look. Almost 500 pips in the space of, what's that, 3 weeks. I mean, 500 pips in 3 weeks is not bad at all. I mean, try getting that by scalping the 1 minute and 5 minute charts. Good luck with that. Okay, so less time chart watching and bigger moves. So what we want to do when we get in on a trend like this is, I don't want to just get excited and exit after, let's say we had a 30 pip stop loss and a 50 pip target, or let's just say a 2-to-1 risk to reward ratio. And so when we hit 60 pips, twice our stop loss, we're going to take profit. So that would be around this point. We would have exited the market, okay, following this breakout. And look how much potential you're leaving on the table. Okay, so I wouldn't have exited prematurely then. Instead, what I would have done is I would have moved my stop loss to break even, just lock the trade in at break even, plus maybe spreads and commissions just to cover costs, and just watch the trade play out. You know, worst case scenario, price turns around, takes out our stop loss at break even, nothing lost, nothing gained. Okay, but best case scenario, we can capture moves like this. Okay, so I would do that, and then as price continued upwards, I move the stop loss from break even to below the lows. Okay, so below this low here, below this low here, below this low here, below this low here, this low here, below this low here, all the way below this low here. So if we didn't exit when we saw this price consolidation in this range, and certainly we would have exited when we seen the market making these lower highs here and all of this bearish price action, we could have potentially trailed this move all the way up to around this point for 400 odd pips. Okay, so we've maximized the trend as much as possible. And if we've got a stop loss of 20 to 30 pips and we get a few losses, we don't panic, because we know when we capture big moves like this, we can make back those losses and then some. Okay, that just emphasizes the importance of money management for you there. But going back to the EMA, okay, you don't actually need it to trade this strategy, funnily enough. I prefer price action, support and resistance, candlestick patterns, and good money management. The EMA is not telling me anything that my eyes can't tell me by looking at the chart. I can look at this chart and say, okay, the trend's up. Obviously, it's good to say after the fact, but even if you go back here, you can see there's an uptrend. You can see you've had the breakout. Okay, even more so here. You know, price is flying up, and what are traders doing? They're entering on the breakouts in line with the trend. It's as simple as that. Okay, so after this breakout, we had this pullback here, and you can see this resistance level. Look how many times it's touched before a breakout, and then it's no coincidence this resistance then becomes support. Okay, traders are watching this. So what happens? Price continues upwards. You've got this wedge formation here. There are videos on wedge formations you can check out. You know, the market making the higher lows. All the signs are there. You've got some bullish candlestick patterns in there. Okay. We've got a 3 inside up formation there. Bearish candle followed by a bullish candle that's 50% of the bearish body. Then another bullish candle that breaks above the high. So, you know, traders may have been looking at even that breakout there. Okay, so there's ample opportunity as the trend continues. Wait, one thing to do, okay, don't buy on the high. Okay, so after you've seen like a move like this, you don't want to buy here when price is this far from the moving average, and here when price is this far. Okay, you want to try and wait for a pullback. Okay, so like we had here, a pullback to the MA, pullback to the MA, or moving average if you prefer. Okay, so that nice pullback there and a breakout. No coincidence we have these big candlesticks as well. You got 3 white soldiers pattern there. It's a good continuation formation. 3 bullish candles, that is. Again, pullback, breakout. That resistance comes support. No coincidence. And I mean, wait again, you know, like clockwork. Okay, breakout in line with the trend. The key to this strategy is first identifying the trend and not trading against it. We won't sell. Price crosses below the MA, we don't sell. Okay, you may look to close part of your position if you're riding the trend, you know, let the rest run, but we're not selling, we're buying because we're in an uptrend, and we're going to look to buy on pullbacks and breakouts. Granted, we won't get it right every time, okay, but more often than not, provided we're not buying too high, we can get in a good trade opportunity there as well. You can see from this big candle here, lots of traders trying to jump in on this trend. But you have to be careful because you don't want to end up buying at the high, okay? So, you know, around here, I mean, there is still opportunity. You can see from this level of resistance that then becomes support. Traders were still buying into this high, but then eventually got caught in what is known as a bull trap, okay? So a bull trap is basically when traders are trying to buy at the high, Okay, getting excited, trying to jump in on this trend. They're really late to the party and they just end up getting their stop losses hit. Traders who were in early take their positions, close their trades. They've made enough profit. They get out and it just causes momentum, as you see, to the downside here. But as I said, when the market starts making these lower highs, you can think about exiting, as well as all these bearish candles as well. Okay, so the EMA trend, how did it help us in this instance? Well, it helped us in terms of the pullback in the trend direction. Okay, but I don't think that's something that we couldn't have done anyway. Okay, so if you do, I do feel like with the moving average, if you add a longer period, let's add the 50 EMA and we'll make it, what color should we make it? Green. Okay, so we'll add the 50. So the 14 here, EMA, is short term, 14 periods. The 50 period we're going to use as the medium term. Let me just remove this trend line. And then we're going to add another one. It's going to be the 200, which will be the long term. And we shall make that blue. Okay, so we've got our short, medium, and long term period EMAs. Okay, the 250 EMAs are two of the big ones. That means that they're watched by lots of traders, retail traders, institutional traders. And when they cross above, it's known as a golden cross. So when the 50 here crosses above the 200, it's known as a golden cross. Okay, so that's a big bullish signal. Just as when the 50 crosses below the 200 is known as a death cross. Okay, which is a strong bearish signal. Again, I wouldn't trade crosses just every time they occur. I mean, that being said, if you traded that cross there and bought, it would have been a good trade. Then as the 50 crossed the 200 there, you would have sold. There was potential in that down move. And even here, we would have rode most of this trend buying on the cross of the 50 and the 200. So the death cross and the golden cross are two different strategies, depending if it's a bullish or bearish market. And I have videos on both of those you might want to check out. But I still would look to time my entry. Okay, and the reason I've popped the 50 and the 200 on the chart here is just to make it easier to visualize the trend. Okay, you can see when we just had that 14 period moving average, it's maybe not as clear, but when you start adding the medium and the long term, then you can look at your chart. Say we're here and the price is moving, you can see after that breakout, you've got a nice separation between these moving averages. They're all pointing upwards. It's a clear uptrend. So I appreciate some traders like the visual appeal of indicators. Personally, I don't think you need them, need these particular ones, just because that does exactly the same thing. That's a trend line. Okay, and you can draw your trend lines how you like. I mean, you can draw them short term, you can draw them medium term. You're just basically marking the lows. Okay, but you can use pretty indicators like these. Choose the colors you want and just use them as a guide. Would have helped you, if you were trading when all of them aligned. If we consider the short one as well, you want them all to align short, medium, long. Okay, so we have the short one, the medium, the long one. We're in an uptrend. Look to time entry, pull back here and enter on the breakout. If you didn't get in early down and around here, this would have been in the aggressive trade, okay, to jump in this trade early. As soon as all three agreed, okay, you could have got in early, or you could have been more conservative and just waited for the pullback. No harm, as long as you've got good money management. As I said, even if your stop loss is hit and this trend doesn't move upwards, you're going to eventually catch a good trend. So the downtrend, I'll give you an example of a downtrend now. This one here, how did we determine this? Well, first of all, we could have marked our resistance and our support, just like we did for the uptrend. Okay, and this is a nice wedge formation. You also have a triple top formation here, which is when resistance is touched at least 3 times. Price begins to move away. You can use your the support known as the neckline within the triple top. So 1, 2, 3. There's the support. Okay, and then the market's making, oops, wrong indicator. The market's making lower highs. Okay, lower highs means it's falling. Means we're going to look to short. Okay, Aggressive traders again would have looked to have traded this breakout here of support, and you can see from that big drop there with that candle, and that's exactly what happened. I mean, there is a 3 inside down candlestick pattern there as well, which is a bullish candle followed by a bearish candle that's 50% of his body, at least 50% of his body, and then another bearish candle that breaks below the initial bullish candle. Again, another 3 inside down pattern there. Okay, I've got videos on the 3 inside up and 3 inside down candlestick pattern. It's one of my favorites to look out for, but you can see it happened twice there, and there was a big breakout to the downside. Could have got in there, and I mean, you would have been happy if you did. If you look at this move, it was the aggressive trade, but you know, over 500 pips profit potential. Okay, the signs were there. There was a, you know, arguably a bull trap. Traders trying to buy into this uptrend here. They're too late. They're buying high. People are taking profits from their long positions here, and then stop losses are getting taken for those who are buying too high. And the inevitable happens, which is a market fall to the downside. Okay. Getting back to the EMA indicators, you can see this is where indicators are lagging. It wasn't until this point when they all agreed. Okay, and when I say when agreed, I mean the short followed by the medium, followed by the long. Okay, remember the 14, the 50, and the 200. So this is the death cross here. Okay, 50 crosses below the 200. And you also have the short-term moving average there. So if you wanted to wait for them all to align, you could have done that. This would have been the more conservative entry. The breakouts happened, you waited for the pullback, and you can get in a nice breakout there to the downside. That's actually an M pattern formation, which is a sign of good support followed by a breakout. Okay, market making lower highs, wedge formation as well. You even have a flag. Okay, a bearish flag pattern, which is down there, and a flag. Okay, see my nice green and red flag, and a breakout to the downside of that. That support actually becomes resistance, and then all of this bearish candlestick action. You can see there's no coincidence the market drop like this. Traders are watching this, and we didn't need no fancy indicators to do that. You know, just trend lines, support and resistance, price action trading, knowing your candlestick patterns, and most importantly, good money management. Okay, the reason I say that most importantly is because let's say you captured both these moves, okay, and you exited for, I don't know, 20 pips, okay, you'd be happy. Oh yeah, I've made 40 pips, but look how much. There were 500 pips on the table there. Okay, so we don't want to exit prematurely. That way it just makes it harder if we take a few losses for 20 pips. I mean, 2 losses for 20 pips is 40 pips. 2 wins for 20 pips is 40 pips, yeah? So you break even. Okay, if you have 2 losses for 20 pips, but then you capture a move like this for 400 pips, I mean, you're going to be up 360 pips, aren't you, after cost? So I like to cut losing trades short and let winning trades run. In this instance, following this breakout, after a pullback, I would have then moved the stop loss. Initial stop loss would have been, for this breakout trade here, I would have placed it above this high. For this breakout trade here, I would have placed it above this high. Then after a pullback and a continuation, I would just place it above the highs. So there, there, there. Arguably around here, even as low down as here. But one thing you can do is you can exit part of the position on the way down as well. Okay, so you can, you know, on this pullback and continuation, you can perhaps look to close 25% of the position, 50%, however much you feel comfortable with, or none of it. Just what I wouldn't do is leave my stop loss up here and let price turn around and turn a winning trade into a losing one. Okay, so once we're in a good position like this, we want to try and maximize the move as much as possible. Okay, when you see the market, as I said before, start to make these higher lows there, even here arguably, you may then want to consider about definitely closing part of the position, if not all of it. There were other opportunities on the way down to enter this trend. You can see here this support line. That's an NFP, non-farmers payroll, first Friday of the month candle. Okay, so you usually get some some big candles like that on the first Friday of the month. But we could have rode the momentum off that to enter into this trend. And then once you see, there's another substantial level of support, we just maybe go to here. Nice level of support there. Okay, got a wedge pattern or diamond formation here, and there's no coincidence. You get a big breakout to the downside. Traders are watching this and looking to get in on this trend. Okay. Again, you don't want to sell too low. You can get caught in a bear trap, which is the same as a bull trap in the opposite direction. Basically, a bear trap being you see a trend, downtrend, you get excited, you try to sell, but you're selling at the low here or here, and then you're just going to get caught out. People are going to take their profits who were in early. Stop losses are going to be hit, and the momentum will be to the upside. Okay, but if we go back to the EMAs again, when they all lined up, this is when we could have looked for our initial trade on the pullback, have another pullback here, breakout to the downside, you could have entered there. Pullback here, you can see that we come into more of a market consolidation here, which is why you probably want to wait for more significant pullback, okay, and then look to enter on a breakout of support, okay, just because it's a bit of a range / consolidation here. Pullback up here again, as I said, we're getting towards perhaps this trend being exhausted, but if you insist, you could have found a trade here, M pattern again and a breakout. You can see from that big candle there, traders were ready to pounce on this breakout to the downside and managed to get in on the action. Okay, pull back again here, same principle, you can trade on the breakout. Okay, so on and so forth. And then when you see the EMAs, they start to tangle like this, okay, and they're not all agreeing. This is when we're in that choppy market scenario. We just want to wait perhaps for a breakout here to the upside. Be interesting to see how this plays out, or a move to the downside, which is looking unlikely at the moment, but obviously things can change. Okay, so we've covered how you can implement the EMA trend indicator into your trading strategy. Basically, to summarize, we just use it to filter the trend direction, okay, to show us clear trends. Just to show you, look how tidy these EMAs were in this trend, and it presented us with nice entry opportunities. Whereas if we look at this trend here, you can see as the EMAs became choppy, they weren't as clear. Okay, that's a situation you want to avoid trading, even if it is an overall downtrend. Okay, you want to try and get in when the EMAs are clearly lined up. Okay, and even then, just because they're clearly lined up, it doesn't mean you sell. For example, you don't want to sell here at the low, especially after these big candles, those 3 black crows. That's the name of that candlestick pattern, 3 bearish candles. Okay, you want to wait for a nice move to the downside. And the earlier you can get in, better. And as I said, good, sensible money management as always. Okay, well, hopefully you found something useful in this video. I do appreciate you watching. If you could please like and subscribe, that would really help my channel. Catch you on the next one.